Thank you for watching Resource Talks. My name is Antonio, and today I'm here with Neil Ringdal. And Neil, you've written a very good thread where, well, this is very much out of my depth, by the way, even though it is called Mining for Dummies, because dummy at this stage is still kind of an aspiration for me. But I think this thread can be very beneficial when understood properly and studied. So I'm very much looking forward to this conversation. Thank you for being here.
Thanks very much.
Pleasure's all mine, of course. And before we start getting into the actual conversation here, though, I would like to warn everyone listening and watching that we have not received monetary compensation for the production of this video from anybody. However, you still need to understand that this channel is a business that sells content producing services to companies, which means you cannot rely on this video for research. Research is conducted by reading official company filings, which you can find on setterplus.ca. Please only watch this if you know what you're doing. This interview is intended only for experienced junior mining speculators because mineral exploration, development, and mining is a very tough business where failure is the norm and should be the expectation. This is going to be a conversation that is general and impersonal in nature, containing forward-looking statements. I am not a licensed financial advisor, neither is Luke. So before continuing on, please do talk to an investment advisor with a good long-term track record because your capital is at risk. And we are neither licensed financial advisors, nor do I personally have a good long-term track record. If you're not 100% sure you understand 100% of the disclaimers that I just showed on your screen, please go to the last section of this video and do not consume this content unless you fully understand and agreed with everything said herein. That all said, I want to jump into the deep end maybe immediately because all too often, at least from what I can see in the online sphere, speculators would see a couple of high grade drill results, maybe even an MRE, maybe even a PEA, and they would assume, oh, this thing is going to be a mine for sure. What I want to start with is if as a speculator, I can only ask one question about a company's open pit design after having seen the MRE or the PEA. What's that one question that I should be asking?
The company. Well, first of all, going back to the whole Lassonde curve and getting into when do you buy, I'm very much, as a mining engineer, a mine operator, and have built a couple of mines myself. I'm very much looking for projects on companies that are past the exploration phase and into construction, or past the construction decision phase. And I guess the one thing for open pit that I'd be looking at is, I'd actually look at a number of things. I don't think there's one. But I'd obviously be looking at the value. First of all, grade is king. But I'd also be looking at, other technical things that maybe might not jump up to the average investor who's not a mining engineer. And apart from those other technical things, I'd be looking at the team. Probably the second biggest thing would be team. Okay, who's building it, and what kind of experience do they have, if any? That's really important. And then the third thing, and perhaps it's obvious to many of us, but it's overlooked, the permitting and community relations side of things.
Yeah.
Okay. I think you need to be fairly well advanced with that too. It's all very well if you have a feasibility study, but if you don't have the permitting to construct, then you can't get it financed. Okay. So often you'll see press releases from companies saying, we got the feasibility done and construction decision. And then you normally see the bar charts, the timeline of construction. And you see permitting, this long bar for permitting, which is normally quite an involved process. And normally it starts overlapping, it's overlapping feasibility work and construction to a degree, depending on which country you're in. But you've got to make sure that, I think you've got to make sure that you've got the green light from the government to go ahead, and to an extent the community, if there's any community issues. We saw that famous mine in Guatemala. I can't remember the name of it now. That silver mine that eventually got sold to Pan American. But they actually went into construction and started mining, but they still didn't have the social buy-in, and that mine basically was a complete dead duck as a result. It was a Tayo Resources, that's right.
Mm.
Um, very high grade mine, great technical underground, great grades, very fast payback period. And but then the communities weren't on board, and there was some dodgy things that had happened with the permitting or something, and it had to shut down. They shut it down. Right.
I
So
really appreciate you of all people saying that, because you're a mining engineer and I fully expected you to start throwing, technical terms at me. And the first thing you go is like social, like if the people are not on board, like if there's water issues, with the community's not getting enough water or water being contaminated or whatever, like that, the thing is not happening. Like that's the very first thing you'd look at. That actually means a lot. Um, and I also like it, like how at the beginning you've lightly said, "Oh, I'm Neil. I've built a couple of mines, nothing too heavy," and then you moved on, which is actually an achievement in and of itself. What's the? I sent you kind of a list of the things that I care the most about when I look at these things. What do you think of that list? And maybe I'll go over it. I've got it here. Grade, as you said, grade is king. Grade, and I wrote grade and grade continuity would be the first thing that I would look at. Second thing is metallurgy. Third thing would be dilution or ore loss. Fourth thing is the geometry of the ore body. Fifth thing is geotechnical stability and structure, meaning the pit wall angles and stuff like that. That's something that I've also seen and heard, that there might be two companies, to that last point, but there might be two companies kind of close to each other, and one of it would publish a PFS assuming very sharp pit wall angles, but there's no way to mine it under those pit wall angles due to the geotechnical stability not being great. And they would essentially not be able to do it unless they work together with the other company. So that's why I've included it on here. That's a new thing to me, actually. But what do you think about that whole list of five things?
I think it's a reasonable list, although I would say metallurgy would be lower on my list of things because when you do a PEA, you have to show some kind of recoverability. And when you go into PFS and FS, or feasibility, pre-feas and feasibility, you actually need to have demonstrated that the material is recoverable. So to a large extent, metallurgy is a lower risk. One has to be careful because there are occasionally deposits that have complex metallurgy. But generally, if the report, if you're looking at a report and you see that it's a well-established, it's a plain CIL and there's no new introduced technology, I don't think it's such a high risk.
Mhm.
And but I guess as a proviso, I'd say maybe consider any new technology a red flag. Okay, that's what I do automatically. Okay. There are companies, there's one I saw the other day, also can't remember the name, where they mentioned they were going to not use cyanides, but they were going to use this new clever technology, CLEVR, which is a different reagent to cyanide, but does the same thing. That's all fine and very well, but there's a reason why most mines in the world aren't using this stuff. Okay. And the reason is I think it's twice the price. Okay. So your reagent cost is double that of cyanide. And the second reason is it's not quite as efficient as cyanide. Okay. So you lose on the recovery side or the revenue side as well. So you lose on the cost and the revenue, but more importantly on the revenue side. It may still be doable, but I have my doubts about that. And people bringing in this technology, it's great, but most countries accept cyanide as a reagent, and you have to take special precautions of it. And people, when they hear the word cyanide, freak out and they go, "Oh my God!" But at the end of the day, it's something that can be managed in any process. Most modern plants have a cyanide destruction process, and most tailings ends up in a tailings storage facility, which is exposed to sunlight, which naturally breaks cyanide down into a stable compound. Okay. The only places where you need to be careful of cyanide is when it's sitting inside uh, 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 I guess a heap leach or something like that. You need some time for it to be leached out. Okay. Before But long-term effects of cyanide generally are low. Its short-term effects, of a cyanide spill or something, which is normally lethal to aquatic life, and in the short term, it's lethal. It'll kill anything in a river if there's a spill into a river. But long term, the river will recover. Okay, and the cyanide will eventually break down into something stable, and there won't be any further risk. So that's a stigma about it. But I guess I got a little bit off topic, but it was just something that I brought up that I thought of as I was speaking. But back to your list, I think technically dilution is definitely right up there after grade. And what mining method is being used and what the impact is on that dilution. Ore body geometry is also important. That determines the strip ratio for an open pit, and also mining methods underground as well. So that's really important. Ore body size as well. If it's massive, like something like Philo, for example, it's a massive resource. So if you mine the whole resource relatively to the waste around it, is obviously going to be a lower strip ratio. But as that resource gets deeper, and it is a deep resource, that increases the strip ratio. So the ore body geometry on your list is directly, directly related to your strip ratio. The geotech for open pits is really, really important, and also for underground. And again, most reports cover that pretty well. If you want to do a pit design and without any geotechnical modeling or geotechnical drilling, which normally happens in feasibility phase, if your report doesn't allude to that kind of work, then that would be a red flag for sure. And then also just common sense, a lot of open pits. I mean, a rule of thumb for open pit is about 40 degrees, 38 degrees, 40 degrees if you want to be conservative. And then if it goes above 45 degrees, start to look at what they've done to mitigate pit slopes. Also, the depth of a pit is very important too with regard to slopes, right? You can model a slope much steeper over a shorter vertical height and have lower risk. But if you have a pit that's going to go down, hundreds of meters, then you need to be aware that the overall slope over those hundreds of vertical meters is quite important. And if it's steeper, then you've got to be in really competent rock, and it needs to be demonstrated. Okay. So yeah, I don't know if I answered that question correctly or not.
Yeah, I think it was really about the top five. Like, am I making any sense? Because that's what I've been looking at so far. What would your top five be?
Well, I would have definitely had community in there and permitting. Okay. Just thinking about it, I've got to think back to when I do due diligence on things. I kind of look at all of those aspects, all the key basically elements. I also would look at QA/QC in the drilling and sampling. Okay. That's normally quite an onerous part of any technical report when you review it, but it's worth having a look at what they say and what the recommendations are in any report with regard to that. In my role, we normally, when we do due diligence, it's for the purposes of, advising somebody or actually having a look at an acquisition ourselves. And so we would do desktop due diligence if it makes sense and then I tend to be generally more, you accept what they're saying. And then when you go to site and you do more detailed due diligence, you get to see, you get to ask a bit more detailed questions, and things might jump out at you that you might not otherwise pick up just reading a technical report or looking at some photographs or Google Maps or something like that. Okay. So for most investors and for your audience, you're basically only doing a desktop due diligence. But it's always good, if there's an opportunity like on a quarterly call or something to, if you feel there might be some doubt, is just ask a question, if it's a slope angle, or if you think the mining method may be, open pit's a bit hard to kind of argue about what approach the guys are taking. because it's much more scientific than underground. But underground is, underground mining is very simple compared to open pit. You have to mine A before you mine B, before you can get to C. Okay, you have to mine in a particular direction, sink a shaft, develop out, or do a ramp, and then you get to the ore body, and then it's the method the layout, the method that you use for mining that that has a bigger impact, and it's very, very tactical. Whereas open pit mining, you do your open pit optimization and your pit design. That's also very tactical. But then once you get, and that's for your optimal pit, but then you can save a lot of money and make a lot of money by adjusting your pushbacks and phasing your waste stripping for better cash flow. And that's more strategic and much more scientific. And there's pretty good software out there that can help you with that. So it's easy. So long as those things are being done, and normally when you look at a technical report, they'll show you the phases of development of an open pit. And if I see that, then it's normally, it's a good go. The guys are on top of it. Okay. And then something I'll also look at is for open pits is what kind of equipment they're using, and what and this goes in line with the geology and I guess the shape of the ore body too, and also the type of ore body it is. If it's a base metal mine or a porphyry, like a gold porphyry, gold copper porphyry, we're talking about a massive ore body which is very disseminated, okay, generally, okay. And so you don't really need that much selectivity. But if you're talking about a gold mine like in Newfoundland or in West Africa, where you're mining Archean rocks, very old rocks, and they're narrow structures with internal waste in between that are going to be mined as a package, or in some places and other places not. You need to be much more selective, and that's very key in terms of the dilution question. If you have a rope shovel, which is used for huge strip ratios and for large tonnages, it's a big machine. It doesn't have a lot of selectivity, but an excavator, which is a backhoe shaped machine, okay, a hydraulic excavator, versus a face shovel, which is basically a bucket digging up through the face. The excavator obviously does the other way around. Excavator is a lot more selective in picking waste apart from ore to a degree. And then key is also the bench height. If you're big open pits, you need to increase your bench height so you can move the volumes that you plan. And you can't go for a 2-meter bench height if you want to do, 30 million tons a year or 40 or 50 million tons a year. A 2-meter bench height is just not going to do it. Okay. You have to go for a bigger bench height, but that comes at a cost of dilution. If you're mining something selective, you might want to consider going a lower bench height, like maybe a 4-meter bench height, and doubling up on your waste for 8 meters. So when you're mining your waste, you're stripping at 8 meters, and then on your ore, you're doing a 4-meter bench. Okay. And I've found that even going down to 2 meters is worthwhile for open pit and a gold mine, where you got narrow stringers between waste. Makes a huge impact on what your head grade is in your mill. And that obviously has a direct impact on your profitability.
Well, there's quite a few moving particles there, and it's again way out of my depth, so it's not as easy to keep track of that. What about for yourself when you actually go to these sites and you look at a mine site after you've looked at the study, whatever it might have been, MREP or whatever?
Yeah.
What's the most common disconnect between kind of a great looking resource and a mine that's actually going to get financed, but then also get built?
It's a good question. I guess, it's hard for me to explain because it's very subjective. But what and I've tweeted about it on occasion in the past. what should investors look for when they look at photos or videos of open pit mines?
Mm.
And I just look for general, back to basics mining practice. Okay. So the first thing I do if I look, but this is already in a mining operation. You're asking the question during construction or pre-production, right?
Yeah, pre-financing even. I mean, if it's
Well, that's really
PEA
hard.
stage.
Yeah, because there's nothing to really evaluate. I mean, then it's more in the domain of the geologist.
Mm.
Okay, because you don't have anything to really see apart from, kicking a few rocks. And no disrespect to any geologists, but we always joke amongst ourselves, there's always a bit of tension between geology and mining. And I think I can say this because my dad's a geologist, so it gives me some leeway. But we always tease each other, and I always say, the geologists just want to lick rocks, and they want to tell you that it's a banded amphibolite, with in a sinistral faulting environment, some technical jargon, and I just want to know if it's waste or ore,
Mm.
okay, and as a miner, but so in a project that's about to go into production or close to the production decision, if you go visit the site, you should see obvious evidence of all the work that they've done. Geotechnical drilling, the exploration drilling. You want to get a look at the routes, the logistics in and out of the area. See if there's any, are they going through any communities, for example. Things that often get overlooked is, or sometimes get overlooked, I guess, not often, but you might have to go through a very small town and the streets are particularly narrow there. And all of a sudden there's going to be, 40 concentrate trucks going through there a day.
Mm.
Okay. So then I would say, hey, what about this town? Are they okay with this idea? Okay. What about these kids, playing in the main street that we just drove past? So you get to see a lot by actually being there. And you get a sense, you can very immediately get a sense from the team whether they know what they're doing or not, you know. Um, but before a mine is financed, generally there's not a lot going on really. There's apart from maybe some exploration drills turning. So there's not a lot to see from my point of view as a mining engineer. Okay. But if I'm looking at a project, I often go and look at projects or mines that are in construction or have been built and are not working well. I always look at those. I look for conditions like the pit floor conditions. Is the floors or the benches, mined level and true? Are they rolling?
Mm.
Because that tells me something. Maybe there's something in the geology or the rock hardness that's causing a problem with the blasting, or maybe it's just poor drilling and blasting control. I look at the amount of big rocks that are on in the muck piles or that have been pushed out of the muck piles because they're too big to load onto a truck for secondary blasting. But I look at pit floor conditions in particular, that they're smooth for the trucks so that you minimize, tire damages and improve. It's like driving a bad road or a good road. If you're on a bad road, everything is very slow. But if you're on a good road, you can get some good speeds, and this is very applicable in the mining business, which is really all about logistics, moving material from A to B.
Mm.
So I look at that, and looking at a site, I always look at the logistics. What is the logistics of moving the material, right? From the pit to the plant, from the pit to the waste dump, or planned waste dump. Okay. If it's underground, what have they, is there anything, the ramp lengths and so on? Are there going to be congestion issues? The the layout of the mine. Where are the crushes underground? If et cetera, et cetera. Okay. So these are very case specific. It's very difficult to talk kind of what is like, not some model that I can just apply directly to, generically to everything. Unfortunately, you've got to look at on a case by case basis. And when you look at an investment opportunity, you should be looking at it and focusing on what is case specific there on each And that's hard to do unless you're actually talking about a specific example, right? So,
Well, I'm a failed accountant, so I need absolute specific examples. But in the absence thereof, there's one thing that I just mentioned, and it was just physical space. Like if the deposit is surrounded by property boundaries, and those properties are owned by other mining companies, and you correct me if I'm wrong, but it's fair to ask the question, what about them? I mean, do you plan on taking them out because you might need them for, if you're for your pit, essentially. Otherwise, you lose your ore, because if your ore is right up to the property boundary, you cannot mine vertically, right? There's an
yeah.
angle. So that's one thing that I recently started paying attention to. Does that matter?
Of course, and there's also mining law may apply too.
Hmm.
But I suppose it's a risk, certainly an open pit point of view. If you're not talking to your neighbor about what you plan to do, then I don't think I mean, most of these companies generally do talk to each other, right? If they've got something next door, um, and they want to now build a big mine, then it normally comes down to a negotiation. Okay, well, what royalty are we going to get if we allow you to mine into our property? Um, I think that's what you're kind of talking about, right?
Yeah.
Um, and then, I mean, there's a very good example, Regulus Resources in Peru. Um, they're right up against, is it Buenaventura?
Yep.
Um, and they have a big open pit planned, but they have to limit the economics into what they can physically mine.
Hmm.
Okay, and that's what they have to disclose to their shareholders, with that boundary, with a hard boundary, because they don't. I mean, I haven't looked at their presentations or news in the last 6 months, but notwithstanding that, they have to present the resource that they can mine inside their envelope that they have, and they can't go, and even though they have resource that is much closer to the boundary that could be mined if the pit physically went over the line, they can't include it. But for sure, they've done the modeling on that, okay, without any restriction. And so they know what the value is. And maybe over beer, they tell you what that is. I mean, you can work it out. It's one of the reasons why I'm still holding that stock. Okay.
Hmm.
Um, so full disclosure. Okay. But they have to have an agreement with the bigger company that's already producing a mine, but before they, and if they have an agreement, I guess that's the hope with Regulus Resources, is that the neighboring mine, includes what they've got in their numbers. So what that means is you have to actually go and look at the economics of that operation and say, okay, well, they're in production, they have significant resources and reserves ahead of them inside their dedicated footprint, but it would make sense if they at some point for them to go across the line. Okay. And obviously, because they're already in production, it makes more sense that that happens rather than Regulus Resource start their own mine. But maybe that's what needs to happen, because, and I'm not putting words in anyone's mouth, or but I'm just saying, leverage is leverage is important in any negotiation, and if you own, if you have a property, an exploration property next to an existing mine, uh, you don't really have a lot of leverage really in negotiating with those guys unless they are going to close their mine down, okay, and they have to mine into your land.
Hmm.
So then you have a bit of leverage. But if there's a 20-year life without that additional parcel, then it's not really much leverage right now.
Yeah.
Okay.
Yeah, exactly.
Yeah.
And just for the record, I'm conflicted on Regulus too. I like their management, and they're also a client of mine, and so
Yeah.
that's where I'm conflicted. But I think with them, nobody really assumes that it would move forward as a standalone mining out. Like that thing moves forward as one mine. Essentially, that's kind of the assumption from talking to people that I know about
Yeah.
it. If you had to guess, and I'll make you do that more today, but if you had to guess, in reality, I'm thinking, how many companies go from PEA to production, or how many projects go from being at the PEA stage to production, and then from the PFS to production? I'd actually just read my own guesses. You let me know if that's right or not. But I think that 80% of companies that at the PEA stage will never make it to a mine, meaning 20 or fewer will make it to a mine, from PEA to a mine. And then PFS, that number might improve. I think 60% will still not make it. So I think most companies at the PFS stage will still not make it to a mine. And then the Lobo Tigre's own research shows that companies that have gotten a financing package, so FID, the majority of them actually do go into production. So you get that kind of green check mark from a Wheaton Precious Metals or whatever it might be. Do you think that's right? I mean, 80% of companies in the PEA stage will not make it to a mine.
I guess so. It could be a bit lower, but how many companies are there out that are out there that we know are already zombie companies, right?
Right.
So yeah, I think a lot depends on the deposit as well and how it's being marketed. I guess, and also how they're being funded, because to get to PEA, you have to do quite a bit of work too. All right. So they've obviously had to invest some money into drilling and putting the PEA together. And I'm not talking about those really, really dodgy little PEAs. I'm talking about something that's perhaps a little bit more robust, okay, where there's been, decent drilling done over a period of time, and is a reasonable resource. But as soon as you have a reasonable resource, ultimately, I'm thinking from a point of view of a technical guy, right? Okay. And knowing that mines are depleting assets, and everyone talks about, what's going to happen with copper when the big copper mines close, and zinc and so on. That's a reality. But as time marches on, assets that were previously not economic become economic. Okay. So on a technical basis. But a lot of those projects don't get built because they've gone and financed it through a stream, okay, or some kind of royalty arrangement, and they've taken the money, and now there's a 8% or a 10% effective chop on the NSR, and that has a huge detrimental effect on the economics of the project. Okay, I can't tell you the number of projects we have walked away from that because the royalties are too high, and because they're not world-class projects, super high-grade projects. They make reasonable money, but the best part of it's been taken by a royalty. Okay. And so it makes it a lot more marginal. And so at the end of the day, the royalty holders enjoy the benefit of a royalty without any risk, without any environmental risk. We all know the business case for a streaming company, right? It's pretty good. But the problem is now more and more mines are being streamed or have streaming finances in part of it. Seems to be the only way to finance things these days. Everyone talks about it. Okay. And a lot of these things are perpetuities. More recently, we've seen some streams with shorter lifespans and step downs and stuff like that. That's all very helpful. But a lot of projects just are killed by that. And so unless there's a renegotiation completely to take those royalties away, those projects will remain on the shelf for decades, maybe centuries. We're just talking about maybe a 20 or 30-year window. So I would say in that shorter time frame, I agree with you, 80% of PEAs don't get built in 20 years, for sure. Okay. I looked at that information by Lobo Tigre, and it's really good research he's done there. I follow him as well. He's a very smart guy. And what he says makes a lot of sense. Actually, I was thinking about it, reading his article. I personally like to invest in those projects after construction decision as well. I prefer that. But I generally don't let go after first production. I generally hang on and enjoy to see the cash flow. Okay, because quite often mines still improve on their cash flows and demonstrate they get further value further down the line. But that's So in other words, I'm long on many of my investments for a number of years.
Hmm.
Okay. A good example for your gold in Nevada was a little heap leach mine. It's basically worked out now. It's got 2 years of life left. But it was a little junior company that got swallowed up by ultimately Calibre, okay, or Calibre Mining. And, I've seen a 400% return on my investment there.
Hmm.
Okay. And that was they were in construction. And then as they went into production, I think just after they were taken out. But I hung on to it. I wasn't very happy that they had been taken out. I tend to not be happy when when a mine gets taken out because I think often it gets diluted. The projects get diluted by the bigger company, and they're not good. I mean, I remember the Lakeshore Gold I thought was a really good company. And is it Lakeshore Gold or I think anyway, there was a Red Lake mine and they were eventually taken up they eventually became, I think, part of Heckler. So I became a shareholder of Heckler. And I didn't like it because I don't think I don't think Heckler is a great company. I think it's good to leverage silver price, but generally I think their costs are too high.
Hmm.
Okay. And so I wasn't happy about that. And I sold perhaps a little bit earlier because of that. And we kind of gone off the topic a little bit. But but going back to lower Tigris, the sweet spot, pre-production sweet spot, I really like that. But I think it's better to actually hold on a little bit longer than just wait for first production or first commercial production and then sell. I think it's actually worth hanging on a little bit longer.
Hmm.
And that's perhaps because I have the romantic notion that a mining company is still a business and actually needs to cover its costs and make good cash flows and return value to its shareholders.
Hmm.
Okay.
I thought a mining company's main business incentive is to stop losing money. Um, w-
Well, old Mark Twain said a mine is a hole in the ground with a layer on top, right?
True. I think Lobo's thing is kind of a foolproof strategy, as in, I understand in your case, when you can actually judge a mining operation as to is this going to go wrong or not, that might make it easier. To go back to the previous point, though, of how many companies make it from PA to production, the topic of size also pops up, as in how much of the size shrinks after PA. So 100% of PA is what, 60% by FID or 80%? And off that, what's going to happen? Like, is half of that actually going to get mined and pulled out of the ground economically within the context of what we were just talking about? What do you think those numbers are? I mean, if I'm looking at 1 million ounces at PEA, how much of that is typically going to come out of the ground? Again, this is a broad generalization, but yeah, I mean, it shrinks, right? So how much of that is actually going to come out of the ground?
I would say a rule of thumb is probably 60 or 70% of what's in the PEA eventually is economic. Normally what happens with PEA is they tend to be quite promotional.
Hmm.
They have a little bit more flexibility in making it look a bit better than it might be. Maybe they don't have the metallurgy perfect and the recoveries come down a bit, or their costs normally are underestimated. Few feasibilities end up with lower costs than what are in the PEA. Okay, so that obviously excludes blocks
Hmm.
from the resource, and um, so yeah, it's definitely a discount to it. It's kind of a PA always to me seems to be like more promotional, and then you get a feasibility, and it's kind of a little bit more cold hard facts, and all of a sudden the IRR is 21% instead of 34%. Okay, or sub 20%, people start to get really nervous. Okay. Um, but having said that, I mean, I'm working on a mine that's been running for 80 years. Okay. Just on 80 years. In 2 years, it'll be 80 years, 78 years.
Hmm.
And I've been on this mine for 8 years now myself, involved with this mine anyway. And the resources 8 years ago was 8 to 12 years. Okay. Measure indicated and inferred. 8 years measure indicated with another 4 or 5 years inferred on the back.
Mm.
And the resource today is the same. Okay. And that is deposit dependent. This is a skarn hosted ore body underground mine. And the guys are constantly finding new stuff, okay, to replace what's been mined. And it'll probably go for another 80 years, okay, because there's a very big footprint that is owned by the company, and only 7% of that footprint's been explored.
Mm.
Okay, so I think footprint's important. Ore body type is important. And so not all mines have a fixed term. People will say, okay, well, so we lose some money in the resource going into feasibility. But you find actually, as time marches on, metal prices increase. And so your pits can get bigger, first of all. And secondly, exploration finds new stuff quite often, or extensions. Okay. And so I tend to be more, I guess I don't take the accounting view, that's what it is 1 million ounces, and that's all that we'll ever have. No, often that you can extend it, and you've just got to be able to know where to look.
Mm. Well,
Yeah,
the LOM, the life of mine, is one of those things that I typically look into when it comes down
yeah,
to looking at a PFS study. I just said a pre-feasibility study, but so a PFS study. And when I look into it, that's one of the things that I look in. That maybe we can go through kind of my top five on that, and you tell me where I'm wrong and what I'm missing. But so LOM is one of it. It's not the first one. I actually look at the initial capex to NPV ratio is kind of the first thing that I would look into. Second thing is that I look at sustaining capex. So sustaining capex and OPEX, of course, and an IRR and payback and LOM, kind of the obvious three things are right there.
yeah.
Is that what you typically look into as well, or are there other stuff to look into in a PFS?
Absolutely. I look at the operating costs, very important, okay, because that determines what is economic.
Mm-hmm.
Um, so I spend a lot of time on that, and then once I'm happy that it's economic, then I start to worry about look at the resource and then look at what capex is required to get those economic blocks out. Okay. And sometimes, so then I look at the block model and often you don't get to see the block model. We get to see a general section, and sometimes a general plan in the geological section of a report. And then in the mining section, you'll see an example of what the mining will look like, the shape of the stopes in an underground mine. In an open pit, you get to see the open pit. And if you're lucky, get a section of the open pit with the resource blocks and then reserve blocks in there. And then if you're lucky, you get to see the same thing with the phases. If the guys have done a good job on the report, if they put that in there, I normally give the report an extra thumbs up, because they're demonstrating important things for me, which is how much waste do I have to strip, and okay, so the ore part is easy in the open pit. We know what that ore is. The average is X dollars per ton, and now I need to look at my waste stripping rate, and that's where people often fall short in open pit, is they look at the strip ratio and they think, oh no, the strip ratio is quite low on this project. And then you look at the cross section and you see the blob of ore body where the high grade ore is a little bit deeper, not that close to the surface. What that means is the initial strip ratio will be a lot higher until you get into that ore. Okay. And so you won't see such a great revenue stream early on, and you've got more cost. And that makes a huge impact on your overall economics.
Mm-hmm.
Even though the strip ratio might be 2-to-1 over the life of the mine, you may find that you have a 4 or 5-to-1 strip ratio over the first 5 years. Okay. And that sometimes gets overlooked by people.
Yeah.
Okay. Which means you obviously need more money to get that done. But generally that stuff's looked at by the financiers. Okay. So if something is financed, that risk is generally lower in open pit. And underground, it's another story entirely, because there what you've got is you've got a cloud of blocks that represents your ore body, or sometimes clouds of blocks. And now you put in a shaft or a decline or whatever it is you're going to get in to mine it. And you look at, it's more a case, like I said, tactical. So you've got to, how long will it take to get that ramp down into the ore body? When do you hit that high grade stuff? Okay. And then how much are clouds separate? If there's separate clouds of ore underground, you've got to develop across through the waste to get to those clouds. First of all, how much of there is that? And and how big are those clouds? Okay. Because clouds of, or lack of a better description, they may be economic to mine and on an operating cost, but your capital cost to get there has got to be covered by that cloud of blocks. Otherwise, it's not worth mining that ramp to get there, right? And that then falls out of your resource. And so if I see quite a dispersed resource underground, and this often happens with PEAs and PFSs of old mines that they're restarting, like up in Canada, these gold mines that they look at. They often make the mistake of they show the high grade that's been mined, and then you have the new shaft going below to the next block that they've found. But you've got to look at that and think about, well, how much capex is it really going to be, and are they still trying to get value from the the old part of the mine, or their sort of things started coming to play a lot more. And yeah, those things would concern me. So OPEX, understanding the OPEX and then relationship with the CAPEX with the OPEX is very key. Okay. Obviously look at NPV as well. If the NPV of the project is good, the IRR, it's also very important. The bigger the project, the more CAPEX you need, the more expectation there is all around. So if it's a huge project like Filo, when people look at it, they have this expectation, this huge expectation, because it's a large project, because the dollar value per ton is so high, because you have 900 meters or 1,200 meters of ore. This is brilliant. This is going to be huge. We're going to be mining 70,000 tons a day, okay, of ore and processing it, which is all great. But those expectations those great expectations. The communities have them, the environmentalists, the anti-mining guys, the government, the investors, everyone has these huge expectations, and that puts a lot of pressure on a project. And because it's a big project with big expectations, it's got big capex. That's probably bigger than it really needs to be, will be bigger than it needs to be, because it has to be top notch. Okay. So there's a lot more risk to manage with a big project than with a small project. So I always look, IRR. So the IRR of a project like that is good because of the value of the ore, but the capex is very high. And then with big projects, they take a bit longer to build than smaller projects, generally. So there's a lot more risk in that than a smaller project like Rio 2, for example, which is a much smaller project, obviously, but the expectations are also lower. Okay. And so by everyone's got lower expectations, because it's not a Filo, it's not going to be a global mover, okay, necessarily. But the economics are sound. Though, it's easier to build. So those kind of things I look at with IRR and NPV. Okay. So a project with a small NPV doesn't really actually, and Lobo's report kind of confirms that, is that the smaller projects tend to be quite very successful once they've gone through that production decision and are financed. Okay. And what I like about I've always found it easier as somebody who's been in the business to build a small mine and grow that small mine into a large mine than to try and build a large mine off the get-go. Okay. It scares communities a lot less if you have a small mine. Okay. And the impact is lower. But once you start talking about huge open pits, there's countries that won't approve, you know, they won't approve an open pit because of the 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 expectations. And in this case, it's mostly negative expectations of what environmental damage can do.
Mm.
Okay. I mean, you know, and it becomes political. Whereas if you have a mine that's already been started and the grade of the blocks are high enough for a smaller mine to be built and still make a profit, because that's the balance. Obviously, if you have a huge mine, it's normally because the grades are too low and you have to move the volumes to get the IRR and the NPV. Okay. But if it's a small mine and you can build it small and then build it out, that to me is a lower risk way to build a mine. And it also has lower expectations with the upside, but you've got to be careful about the upside. And that's where we are with public companies. Everyone wants to know what's the blue sky
Mm.
and what is this thing worth? And I don't think that's necessarily the right way to go about it, because you then talk about the blue sky. Everyone's got these great expectations, and maybe they're not realizable because of the community or something we haven't foreseen. But if you can build something that's maybe smaller, maybe not as interesting, because it's not such a huge NPV, but it has a 35% IRR or 40% IRR, then why not do that? And then now you have the community, now you're operating the mine, you've built up a better relationship with the communities, they've seen what you're doing. Now you can go and look at expanding that mine, and you already have a little bit of a track record. And I'm speaking particularly with the communities. Okay. And the other thing with starting smaller is, if you start big, you've got to own the surface rights as well and everything up front, really, or have that tied up in one way or another. If you start smaller, you can start acquire surface rights maybe around the property more slowly, and you don't have to spend so much money up front necessarily, just because the expectations are lower, right?
Yeah. And that's actually, if I had to guess as to why the returns maybe are better, I would think sensitivity. Sensitivity is another thing that I typically look at. Of course, the metal price assumptions matter there in the PFS or in these studies. You actually mentioned it in the thread that if metal prices go up, then the pit naturally gets bigger. But is that a thing? Like, do companies often design their pits based on metal prices that are too optimistic, and then they end up in financial troubles when prices drop?
Open pit mining, when you do your pit optimization, you've got to take a conservative view. So I don't think that's really the case. More than often not, if the price drops after like right now, or let's take 2012 or 2011 was it 2010 when the gold price was at a peak and the silver price was at a peak. There were some cases where feasibility studies, or not feasibility studies, say PEAs, came out with quite optimistic projections on the gold price and had fairly big pits. And then obviously if the gold price goes down, metal prices drop, then you're in trouble.
Hmm.
Okay. Also, the thing about open pit mining is, they always talk, I don't know if you understand but when you do a pit optimization, what the pit optimization tool does is it works out the optimum pit at a range of metal prices that you normally select around the revenue factor of 1, which is your revenue factor 1 is what your ideal long-term metal price will be, which is normally on a trailing average of 2 or 3 years of the metal price, or whatever the case might be. Okay. Well, so it'll be a little bit more conservative. And then you look at how big a pit it is, as the metal price increases. And then you look at the size of the pit if you have a fraction of the metal price.
Hmm.
And that first pit that you have at a fraction of the metal price, that's really your ideal starter pit to start the mine on. Okay. Because that's obviously the most profitable pit at that low price. And we got a much higher price. So it's going to make more money for you at a higher price. Okay. your stripping ratio will be lowest relative to the amount of ore you're producing out of it. Okay. So you normally start off there as a starter to your final pit. And during the life of the mine, if it's properly been done and your numbers are right, you should have downside protection from an open pit, unless you've got a problem with your grade control or your dilution. Okay, as I've mentioned before, Guyana, was it Guyana Minerals, that open pit in Guyana? There was a complete disaster. Okay. I can never remember the name so well, but there was a classic case of them, not only not mining a lot of dilution in their pit, more than they thought they would have, but also their ramp accesses were terribly designed. They had a very bad design. You want to have multiple ramp accesses to a pit so that you don't end up cutting off ore while you're trying to do waste stripping. Because people don't think about that. And I need to make a couple more posts about this, but when you waste strip and you push back on the edge of the pit that's already mined, you're pushing back the next phase. When you blast that block, material always kicks down into the lower part of the pit. Okay. And so you can't use any ramps below that where you're mining very easily a lot of the time. And so you have to have another ramp system to the bottom of the pit to continue mining where you're getting your ore out while you do your next waste cut. And it was that simple. And they ran into a wall. And also there's something people don't think about is general managers want to make a name for themselves and move on to the next job because they want to become a CEO. Okay. Got all these guys, got fewer and fewer mining engineers, and they all want to be bosses. Okay. And so you go very quickly through the ranks as a young mining engineer, become a general manager, and you want to make a name for yourself. You join a company and you're going to be there for 2 or 3 years, and then you're going to jump to CEO or COO. Okay. And so what the guys do is they make that pit produce really well to give them a great name while they're there. And the next poor guy who's on the job suddenly has a whole lot of waste stripping to catch up with because they've mined too much ore and they haven't mined enough waste to make the economics better. So in the short term, it's very economical. Everyone's happy. This guy's a hero. Okay. He leaves, and the following year or two is a disaster, and everyone can't understand why the quarterlies are so bad because they've had to catch up with a whole lot of waste stripping. And sometimes mines get to the point where they have to close because they just can't deal with it. They just can't cover their costs. Okay. Yeah. And so it's very, you've got to really be on it. And it's actually very hard for an investor to catch up, even someone like me, unless I know, that unless I visit the pit and see that, it's hard to know. Okay. And that is a risk with buying a company that's got open pit mine that's in production, for sure.
That actually makes me think about combining our two worlds, so accounting and mining engineering, and whether that even makes sense in the first place, as in using a DCF, a discounted cash flow valuation method, and these things. I've always thought that it doesn't make sense to use it on mining, but now hearing you talk about it, it makes even less sense. Do you use any kind of financial valuation financial modeling to value mines, or how do you do it?
Absolutely. Yeah, a discounted. I don't know if I agree with a risk adjusted discount. Okay. But I think it does make sense to discount something because it does build on a little bit of more conservatism. But what I've also found, and I can say this now because I'm not a director of any public company, people don't like to hear this, but it's the truth. That there are so many variables that go into a feasibility study and a PEA. You can actually tweak each little variable, just a little, and it'll make the project look like a beautiful thing. But if you look at each one of those variables, you might actually say, that's a reasonable assumption. Okay. But it's a little bit optimistic. Each one's a bit optimistic. And so you end up with great economics. And you can equally go and build so much conservatism that it never makes any money. Okay. And there's always this interesting dynamic, having done this a few times with various companies as a consultant, and then also on the other side as a issuer, okay, who has to rely on an independent consultant. You get the consultants, you have to partner with the consultants, and the consultants are concerned with also, they don't want to ruin their name either. The last thing you want to do is have a mine that is a dud, okay, the phoenix, okay. So they tend to can be overly conservative in the assumptions, and it's their right to do so as a as an independent company. But I'm sure there are conditions under which these consultants may not be that conservative. Okay, and that's when they run into trouble. So generally they tend to be conservative, but if you go and tweak each one of those variables a little bit, you end up with something that's not actually really that close to what the reality will be. Okay, either way. And so the key is really focusing on what are of those variables, which ones are the greatest risk. And we always see in the DCF analysis, the cost, the capex, and the price, normally, right? Those are the things that vary, and they give you a sensitivity of those three. But those aren't necessarily the drivers. Okay. Like, what about dilution? Okay. And so we as investors should take that and do some desktop work on the models. And that's what I like to do. When I do my desktop analysis, I always look at these things. I say, okay, well, what is it? This method, my underground mining method may, as soon as we talk about long hole stoping, I get concerned if the ore bodies are narrower. Okay. As soon as they get below 3 meters in width, I start to get very nervous about long hole stoping, and I start to add 20 to 30% more dilution into my model to see what it'll look like. Okay. Um, and see what it does. So I try and make a model of a typical year of production using their typical costs and production, and open pit the same thing. And then I vary that, and then I play with the waste stripping ratio, if it's open pit or underground. I play with the dilution, and I can play with the dilution open pit as well. Play with the recovery. Sometimes they have recovery. Quite often they have recoveries in a DCF analysis as well, right? Recoveries aren't normally the one. It's mining recovery, okay, or mining dilution, mining recovery, more so than processing recovery, okay. An underground mine for sure. An open pit mine, it's dilution if it's a gold mine, right, or a uranium mine. But if it's a base metals mine, dilution is not really an issue there for me. What would be my big concerns in an open pit I would probably just be looking at I'll be looking more at my truck factors and all that kind of thing. Okay. I don't know if I'm answering you with too long-winded answers, or if I'm just making it more complicated. but yeah, I think, to come back to your discounted cash flow, yes, I still use those because it's just an extra bit of overall conservatism on the whole project. Yeah.
What is it that, and you've dealt with financiers, you actually just mentioned it a couple of minutes ago. What is it that they look at? I mean, the people who are supposed to sign off on a financing package, is it the same things? Do they just have like mining engineers on staff and they tell them the same things, or do they have some kind of a secret sauce?
No, I mean, most streaming companies have their own technical experts, okay, who go and do their due diligence. And so it's important. Who is that technical expert as well? That's something we didn't really talk about, but who that person is important. And then other financiers, banks, and that will normally outsource a consulting company to do the due diligence. Okay. So who that person is quite important. I've seen it's actually quite frustrating for me because I know these numbers. And so sometimes I bang head with these consultants because I think they're being overly conservative other times. And of course, on my projects, I want them to be less conservative because I'm optimistic about my project naturally. Okay. But I understand why they sometimes stick to their conservative values. But on certain times, sometimes, and this is the problem we got, is the skills of the consultants aren't that great. Okay. Unfortunately, we have a shortage of good mining engineers and good geologists, and this is getting worse and worse and worse every year because mining is generally perceived by public to be a bad thing. And so young kids don't seem to see the opportunities. I don't know what it is, but they don't go into it as much as they used to. Okay. And so we have less and less people with good mining knowledge doing these due diligences and doing these technical reports. And that's by far the biggest risk, actually. All right. If we just had more technical people with 30 or 40 years doing PEAs and feasibility studies, we'd see a lot more success. I think that's possibly, I mean, just speaking about it, rambling on as I do, I think that might be a key point.
Yeah.
Okay.
Well,
You know, I've also been in the situation where we've get a consultant in and they look at your resource and they cut their resource by 40%.
hmm.
Okay. Just because they've taken a different modeling approach, you know, that may or may not be correct, but these things can happen and do happen. We've seen it, right?
Yeah. If you were a mining CEO, a promoter, and you knew your pit design was flawed or the PA wouldn't actually work, how would you go about covering it up to keep raising money? What should I be on the lookout for from coming from someone like you with the insight to do it? I'm not saying you would, but you have the insight to.
Um, well, I don't know. I probably shoot myself if I'm in that position. But it's a good question.
Yeah. Let's say your family or whatever depended on it, get into your head. You had to do it. There's no other way around it. You had to cover it up. You had to make everyone believe that it's going to work, while in
It's going to
reality,
come out in the wash eventually, right?
sure. But
Um, I mean, these people can't hide this stuff for long. They eventually get found out.
hmm,
So, I mean, you just keep lying. That's what, that's what happens a lot of the time, I suppose. And I'm not sure if it's always with intent. It might be just people thinking that they have something really great, and it's just not
hmm,
because they don't have the experience.
okay.
I don't think. Do you think these people really want to build something if they think it's going to not work? Maybe there are a few. I mean, there must be people like that out there, I suppose. And I've also heard people say mining industry is, filled with a lot of really bad people, but the few good people that are there are really, really good. And I think that's true too.
Hmm,
Um, what to look out for? I think it's just got to come back to the fundamentals. You know, um, I always get nervous of press releases that talk about first production. Okay. Um, and then first production's one thing, commercial production's another. Okay. Um, so that's very promotional. I get very concerned about, and you see it more on the exploration side where people take drill hole intercepts and they put them up on highlights. And they've got drill log calculators now that everybody uses. But when people highlight these either zinc equivalent grades or gold equivalent grades or copper equivalent grades that are, fantastic, and then you look, they've got all these deleterious elements in them that no one takes take into account,
hmm,
or polymetallic assets that have, multiple copper, zinc, lead, multiple base metals, and and then you look at the recoveries assumptions, they're all very high. that's not realistic, because generally one of your base metals will take a knock on recovery to get the better concentrates of the others. Okay, if you got more than two.
Yeah.
Um, yeah. Um, there's lots of comment out there by people who know more about the stuff than I do about, press releases, being super optimistic. And if there's bad news in a press release, then things must be very, very bad indeed. Okay. Because it's always put in the best possible light. I think that's very true. So if there is some bad news, I mean, you need to have a good look at it, unfortunately, because it probably is really bad news. Um,
I think
I don't
we talked about the egregious things, the big things really that even I can understand sometimes. But there's other stuff that you mentioned in that thread too that I think are kind of subtle nuances that you've brought them up multiple times, but they're not necessarily the things that everyone thinks, like bench width, haul truck delays, and ramp design. Those are things that I, as a retail speculator, I don't really ever think about them, but they can sometimes make or break a mine. What is out of the seemingly small design issues? What's something that can completely ruin a mining operation that I should bring into my repertoire of things that I look at?
all of those things. Um,
Those three, so bench width.
yeah, I'd say
Um,
bench height's a very important one. Is very, very important.
okay.
Okay. Um, Big machines in open pit mining are more productive if you have a reasonable bench height. Okay. So like the really big pits in South America and in North America, around the world, they generally have 12 to 15-meter bench heights. But those are massive porphyry type mines or massive ore bodies. Okay. Big M Canyon, all those guys. Okay. And that's because when you blast something that high, you can load a bucket in one single scoop with a rope shovel, okay, which is the lowest cost and most efficient loading machine, okay. But it takes that whole scoop, but in one scoop, it fills the bucket up the length of the face, and it moves a lot horizontally as well as vertically in that swing. And so it will mix whatever is in that cut, in that face, if you can imagine it. Okay. So if you have some veins in that, it's going to mix everything. And if that's part of the plan, great. So the relationship of the shape of the ore body versus the type of mining method is really important. What the Australians have been pretty good at doing is mining selectively. And I think they're probably the best in the world in that regard in open pit. Okay. Is they often mix their fleets. So they'll have a bigger machine doing the waste stripping off to the side of the ore bodies. And then in a where you've got narrower structures that you need to manage, they will cut down on the bench height.
Mm.
Okay. And I've done that in Africa as well. We actually used a 2-meter bench height on a gold deposit where we had steeply dipping structures that were up to 8 meters wide, 10 meters wide in places, sometimes 15, but down to 2 meters wide.
Mm.
So, and I must dig up an old tweet that I've got and repost it of the impact of bench height on dilution. Now, the problem with a narrow bench height, like 2 meters, is you can't actually blast that very easily because you've got to drill much thinner blast hole diameters. So it's much more drilling. And also, it doesn't produce a lot of tonnage. Okay. And that's the problem. With a 15-meter bench height, you can do a lot of tonnage with one blast. And so there's limitations as to the mining rates you have with going with a shorter bench height. Okay. So matching that is really important. But I would say one has to look at that on narrow veins. And so I'm very interested in this project in Newfoundland that Calibre got. Okay. Whether they're able to achieve their plan, because that's exactly that. It's a gold vein system. It's a matrix of veins, so each bench will be different. And if they go for too thick a bench, and that's my concern, it might be a little bit too thick. they may get more dilution than they planned.
Mm.
Okay. So it's a case of geometry, really, right? I don't have any pictures at my fingertips to explain it, but if you have a vein that's 2 meters wide and you're surrounded by waste, and you blast that in a 5 meter bench height or 4 meter bench height, let's say 4 meter bench height, which is a reasonable bench height for open pit blasting. It's narrow, but it's still doable. That whole muck pile moves and mixes as it blasts. Okay, it mixes to an extent, and so that 2 meters becomes probably 3 meters wide, maybe after the blast, 3.5 meters wide. So there is an element of dilution in there. Okay, that could be 50%. All right, on a 4 meter blast. Now, when you blast a 15 meter bench, that muck pile moves a lot further because it's a much higher bench. It moves a lot further, so there's more mixing in the material. Okay, and that's the issue. So even if you get selective with it, with an excavator versus a rope shovel, you still got too much dilution in your blast. Okay. So that to me is one that's fascinated me for years, and having worked on platinum open pit mining in South Africa and gold open pit mining in West Africa, we were able to really improve our head grades by about 20% just by fiddling with those things. We even took and put electronic machine detectors that could survive a blast, and or they weren't detectors. I think they were magnets or little pieces of metal we put in, and we used magnetometers and stuff to measure where these things went, to try and work out the science of the movement of a muck pile from solid to broken material, and see how much movement there is in there, and then try and optimize for that. So that's one thing, bench height. The other thing is the grade control in the open pit, which is the infill drilling, if you like, that you have a model that's measured, fine, but bench to bench, it can change quite a bit, especially in a gold type pit, in a gold pit. Not a porphyry, not a big, massive, narrow vein type stuff, or structures, narrow structures. The key there is to have a density of drilling sufficiently close to be able to model literally each blast carefully before and after the blast based on that drilling, and map it on the floor of the pit, so when the excavator comes to dig it, it knows your dig lines are best representing that ore. Okay, and so if you don't do that, either blast hole sampling or detailed infill drilling program between your blast holes on a smaller grid basis, then you're going to have problems with dilution for sure. You won't know where that ore line really is, just based on a model that's longer term, that may be measured from a geostatistical point of view. From a practical point of view, when you mine it, those ore lines are very, very important to know where they are and where they're going to move after the blast. Yeah, does that make sense?
That makes sense. And I wrote down a couple of things on the bench height, which seemed something very important, something that I hadn't thought about before really, or ever paid attention to. But essentially, if the bench height, first thing, was it ever mentioned in the first place, or how well explained was it in the study that you're reading? And if it's not too well explained, then that could be a red flag in and of itself, it sounds to me.
Correct.
If the bench height is too high, ore and waste mix can increase dilution essentially, because they would mix. Exactly. And if it's too low, then selectivity can improve, but then the efficiency will drop over time.
Yeah
Okay,
that's right.
That's what I've written down.
Your efficiencies are much lower. You can't mine as much tonnage. And it's all about moving volumes open pit, right? So especially bigger ones. So that Valentine open pits in Newfoundland, if you look at their technical report, they do go into that. They do go into this information on what they're going to do with the grade control. They discuss it. And I think that's a good case study. It'll be a good case study to follow over the coming months, because they're about to go into production there, right?
Right. Yeah.
So it'll be interesting to see. That'll be a good benchmark for your listeners for your followers to have a look at. Okay.
Yeah. Neil, I can imagine that at this point you must be tired of looking at my face. So
I
I'll
just know
let
if you're tired of listening to my voice.
not at all. I can do this for a couple of more hours. What should we talk about next time when we sit down? Assuming that you would want to sit through another one of these, what should we talk about next time?
Um, we could talk about underground a bit more, maybe.
Yep.
And we can, I'm happy to talk about certain case studies as well with prior advance, so I can read them and give you my opinion if you want.
Yeah. Case
Okay.
studies and underground.
Um,
That's it.
that might be interesting. Or otherwise just general stuff. I mean, I can think of, you know, I don't know how useful my Twitter profile is, but
Very.
what I've tried to do and I've thought about doing a bit more is sort of mining technical Q&A.
Hmm.
Okay, so case studies, theoretical, probably for the most part, but maybe some practical case studies where I present a question. Hopefully I can present a concept and then actually question the audience and let people come up with their answers. I did that fairly recently. It seemed to be fairly get a bit of interest from a few people anyway.
Sure.
On how many trucks should I buy to meet a certain tonnage based on this certain information, and
Hmm.
just help people understand how people go about, selecting a fleet and a fleet size for an open pit mine, for example.
Right.
Okay. I've also thought about taking that thread that you mentioned, another step or two. Actually, I retweeted it today, so people can read it who haven't. But maybe doing a couple more threads of, going into the more detailed phasing of an open pit, how that works. Okay, when you do, because that really has a big impact on your cash flow.
Mhm.
Okay, and NPV of a project, and how that works, and how you can, just looking at that, you can improve the economics of a pit very, very dramatically. Um, and then also, when do you go underground from open pit? Okay. Or do you go underground or do you go open pit? Those decisions, those type of things.
Mhm.
Yeah.
Well, that's wonderful, and you should do all that. It's Neil Ringdahl for people listening on Twitter. I'm gonna have it up on the screen right now so people can see the right spelling there. But it's a wonderful Twitter profile. I follow a lot of what you do. Most of the times, it's I'm just there to be a clown and make a couple of jokes, but for the
Not
rest
at
of it, it's
all.
been very helpful. Thank you,
Thank
Neil.
you,
I
sir.
really appreciate your time. Thank you so much for doing this.
Really appreciate the time as well.
And thank you to everyone for listening and watching. This was an interesting conversation. Any and all questions for future interviews are, of course, welcome. Please post them in the comments. But I am still going to kind of repeat the warning that I said at the beginning, that everything, everything combined with the warning that I gave you at the beginning is to say that you should treat this program as biased entertainment instead of unbiased journalism, because there will always be some type of bias in what everyone tells you online. They may own shares of the company, they may be a director, they may have been paid by the company, and so on and so forth. Now, this entertainment program specifically is intended only for experienced junior mining speculators, because mineral exploration, development, and mining is a very tough business. Losing money is the norm and should be the expectation, as this is a very complex sector, and the performance of individual companies typically depends on many different things, including geopolitics, macroeconomics, commodity prices, and many other moving particles that are typically outside of anybody's control, and no one can really proceed him, because unfortunately, and believe me, I have tried and I might even keep trying, though I doubt I'll ever be successful. I just don't possess any superior knowledge about the potential direction of any stock or commodity price. And at least to my understanding, nobody out there does. So you should not rely on this program for directional advice or advice of any sorts, as this was a conversation that was general and impersonal in nature between a couple of individuals, none of whom are your licensed financial advisor and none of whom can see the future. So, no guarantees can be made about future events, and past performance is not a guarantee of future results. So, please talk to a professional licensed investment advisor with a good long term track record, as well as do more research before taking any decisions. by visiting setterplus.com, where you'll find the official filings of the companies that might have been discussed in here today. And if you don't do that, you're highly likely to lose your money. There's a couple of documents that are absolutely obligatory reading for people interested in the space. And that is, of course, the MD&A, which is the Management Discussion and Analysis. And it's an official document that the company publishes on setterplus.ca. You want us to look at the financial statements of any company and understand how and why and where they spend money. And you also want to look at the Management Information Circular, which is going to tell you how much money each insider of a company earns in total compensation, bonuses, and everything, and all the other incentives that they might have. It's also going to show you if there are any change of control fees and whatnot. It's a very important document. And then, of course, this is a technically focused business. So you also want to read the NI 43-101 technical disclosure. And again, if you don't understand it, consult with someone who does understand these things. Because if you don't do that, you are highly likely to lose your money. So, yes, thank you so much for listening to this. And I'll leave you with one of my favorite Charlie Munger quotes, which was, if you don't understand it, don't do it.